Guys, I am here today on a solo episode with someone that has been in our world for a really long time, and I'm very excited to have her on the pod. We have Jordan from FitBooks.
Hello, everybody.
Welcome.
Thank you for having me.
Is it the first podcast?
Yes, very first ever. So that's good. It was a really big goal that I wanted to tick off this year. So
we have a thing of stealing people's podcast virginity. Everyone, this is my first.
Well, I'm so glad you were my first time.
Yeah. Kira isn't here today, guys, because it's actually Saturday. So Jordan and I were very busy girls. We had to film on the weekend. So this is going to be a pretty chatty. We've honestly been chatting already for about an hour.
Yeah.
We probably should have done that on the pod.
Probably. Oh, well. We're recording now.
But Jordan and I work together a lot. We share a lot of clients and we refer pretty exclusively to each other. So there's lots of topics that I know that everyone listening is going to have problems with, and we're just going to basically quick fire to Jordan. But for those who don't know who you are, give a bit of a background, what you do, who you are, where you're from.
So I've been an accountant for probably about 7 years now. I started when I was an undergrad, just at like this little boutique tax accounting firm. And, you know, I've always enjoyed the fitness industry, going to the gym, bodybuilding, all that stuff. Love that. And then it kind of got to a point, let's say about 2023, I had, I'll be honest, a little bit of a mental breakdown. I was like, I don't want to do this anymore. I'm so like fed up with corporate life. Like I hate it so much.
Yeah.
And so I started working reception at a gym.
Yeah.
And literally every single person that I spoke to that came in and heard that I was an accountant was pretty much like either, oh my God, I haven't done my taxes in like 5 years, or they did that like scared little like, no, I don't love that, don't love accounting, I don't understand any of it, and they wanted me to do their tax returns and everything like that. And so I was kind of like, oh, okay, plants the seed a little bit, I'll just start this up. And then FitBooks was born. And so, yeah, I've done accounting for a while now. FitBooks has been happening since 2023 kind of, but it only really kicked off like last year was when I sort of really started taking it seriously and doing everything for it. And I actually quit my part-time job at the end of last year because my client list got a little bit too full to be doing two things, and I was working 7 days a week. So,
and from my understanding, you became chartered last year, didn't you?
yes, and a registered tax agent too.
So can you explain what that means? Because I feel like a lot of people don't understand bookkeeper to accountant to chartered accountant and like all the quals in between, because it's a pretty lengthy process, isn't it?
Yeah, it takes a while.
Yeah.
So I did my full university qualification in business and commerce, which is accounting.
Is it?
Yes, it's like money business. So
I thought it was just an accounting degree.
well, you can major in accounting. Most of them, Griffith does a commerce course, but like QUT and stuff will do like a Bachelor of Business with a major in accounting. So
There you go. Learn something new every day.
yes,
There you go.
so
Sorry.
I got a double there. But that qualifies me to be a full-on accountant. So to be a bookkeeper, you only need like a cert.
Yep.
And then you can't lodge any reports with the ATO or anything like that under either of those until you're a registered tax agent, which you need to do all of these extra like little courses for, which thankfully were covered by university and chartered accountant. Chartered accountant was another probably 2.5 years of study. And that's essentially a graduate diploma. So not a full postgrad degree, but kind of like a half postgrad degree, I guess. And then that's the point where it's pretty much like a industry standard in accounting where a chartered accountant is kind of where you want to be, sort of the same as a CPA. It's just that extra qualification that puts you at that senior level and gives you that extra knowledge.
And that is when you can lodge with the tax.
The registered tax agent is when you can lodge. So as a chartered accountant, you still can't.
Yeah.
But once you've got up enough hours, you can then apply to the Tax Practitioners Board and become a registered tax agent, which is where you can lodge tax returns, BASs, all that stuff with the ATO.
Oh, I heard that Australian tax is one of the most complicated tax systems in the world.
I think it's not too bad for me, but I've also done it since I was in high school. So by this point, I'm like, yeah, it's just normal. But it is pretty confusing for people who are just coming into it, especially if they haven't, I work exclusively with fitness coaches, and most of them have no idea about any of this because they've never done it before. So trying to explain it to them in a way that they'll understand without all of this accounting jargon and nonsense that they haven't learned before that I've accumulated over this time is something that I found pretty challenging at the start. And I think I've got it down a little bit more now, but
we're definitely going to dive into it today. Yeah. Because finances is one of the things. I'm a big believer that you can have an understanding, but you should never do it alone, ever.
Yes.
Do you agree? One of the questions I get a lot is, what's the first expense that you should have in business? And I always say an accountant or bookkeeper, straight up.
I think that's a great idea.
Yeah.
I mean, I'm a bit biased probably, but
yeah. I just think it's so important for your anxiety around your finances, hey, because what the hell is, when you start, I remember when I first started, I was like, what am I doing? How do I pay tax? I knew I had to put money aside for tax, but yeah.
Yeah. How important is it really? Can't I just lodge late? Don't do that.
Yeah, never.
Don't do that.
So we'll dive straight into it because I know everyone's like, please tell me about tax. First question I want to ask you though, the golden rule of 30% of income to put away, do you agree with it?
I usually actually go for 25.
Yeah. Does that include tax only, or is that super as well, or?
That's tax only. Yep. Super is a bit of a tricky one because I find that a lot of coaches who are starting out, they probably aren't going to have the cash flow to be able to part with that. But as you grow, I think it's probably one of the best investments that you can make because it's investing into your future. It's giving you the freedom to retire when you want to, or to take time off work when you're older and step back from the business. And it also gives you a tax deduction without you having to spend the money and give it to somebody else because it's still yours. You just can't touch it for the next 30 odd years.
So it's a tax deduction when you pay it.
Yes.
Girl, that's cool.
And you can do up to 30,000 for a tax deduction.
Oh.
And it does go up most years. So.
Well, there you go. Yeah, super is the bane of my life, but it's also the best thing ever.
Yeah. It's a great little tool.
But as people that get started, getting started from your business from the get-go, just always put 25% aside. Is that what you'd say?
I would say from the start, yes. Yeah. Because as you first start out, you're probably going to be spending more than you earn, if not most of what you earn. So if you're putting away 30% of your income, then you're probably not going to have enough left to cover all of your expenses and then actually live.
Yeah.
Whereas, when you pay tax, you're paying it on your profit, not on your income. So your profit is what becomes your taxable income at the end of the day, which means that after all of your deductions, after all of your business expenses, that's what they're taxing it on.
Yeah.
So if we say 25% of your income, it's probably going to be somewhere around there after we take into account expenses as a nice little starting rule.
Okay, we're definitely going to get into that because I'm sure everyone just listened to that. They're like, what? So I'm going to ask you a whole bunch of questions that I go through with my guys all the time, just because I feel like it's really good to get it from an accounting perspective. So number one is, how much money do I put aside to pay tax? So 25%, just rule of thumb. When you're talking about deductions, what is that?
So deductions are all of the expenses that you have for your work and for your business. So that's things like gym rent, if you're on the floor, any uniforms that you buy, Everfit, Trainerize, Forward Moves, FitBooks, were all business deductions. Things like any extra subscriptions that you have to Google, to Microsoft, all of your different behind the scenes work, Coachbase, that sort of thing. It's all going to be deductible. And what that essentially means is that it takes it off your income at the end of the day so that when you're taxed on what's left after those expenses that you need to make income.
So let's give them a tangible example. So let's just say you're making $2,000 a week and then you have $500 of deductions. Do you classify these as cost of goods?
I don't.
Yeah.
Just because in the service industry, most of these are going to be indirect costs. They're not going to be direct. So I don't class them as cost of goods. I just class them as like operating expenses. So you need that to run your business still. But it's not going to be like, in order to sell this one thing, I absolutely need to have this, because most of them are going to be things that you can play around with a little bit.
Do you, for those not knowing what we're talking about, we're kind of talking about a P&L, so we will get to this. But on Xero, you have your income, and then you have your cost of goods, and then you have your operating expenses.
Yes.
So your cost of goods creates your gross profit, and then your operating creates your net, which, guys, if you're listening to this, we are going to explain it. The reason why I ask is because you've probably seen the way that I work, and I have like my advisor, I have everyone in my cost of goods, because I just want to know how much my business is to run as is right now. So can that be really flexible with what you put in it?
It can be to an extent. Everyone's going to be a little bit different. If you have, you know, contractors that you pay as a percentage of your clients. So if you have a coach working under you and you give them, say, 60% and you keep 40, I'd probably try and put that in cost of goods, because you're going to need to spend that based on the clients that they have. But I find that for a lot of people in the fitness industry, splitting it up between cost of goods, gross profit, operating expenses, net profit is just far too overwhelming and confusing. So when I'm presenting a P&L to my clients, I usually just go income, expenses, profit, just to make it super simple and straightforward.
I feel like we should do a second episode on Xero itself.
Yes.
Because I get questions around like, what's a P&L, or like, why is my cash in versus cash out different to my P&L? And I'm like, I don't know how to explain this simply. So as we we're saying, so you make $2,000 a week, then you have $5,000 of direct costs or indirect costs. What's the difference between direct and indirect?
Direct cost is going to be if you don't pay that per client or per ebook that you sell or anything like that, then you're not going to sell it. So you absolutely can't make that income. That's going to be directly related to that particular thing. It'll be, you know, like if you're an activewear company and you have, you know, your materials that you buy, like those raw materials of your actual products, that's a cost of goods, because you absolutely can't sell activewear unless you buy the activewear first.
Would that be like paying for trainer ads because they can't service a customer without using the training app?
In a way, yes.
Yeah.
A lot of them do go on a band though. So that's going to create some ambiguity there. So trainer eyes, yes, because you pay per seat. Same with Everfit. But with things like Core Coach that has just come out, that's just a flat thing for up to 200 people. So I'd probably just make that a normal expense anyways.
Okay. And then indirect is operating expenses. So like ad hoc kind of things.
Yeah. All of your administrative stuff, things like, I mean, gym rent would probably go under a direct cost for a face-to-face PT, because you can't train a PT train a client face-to-face without paying that gym rent. But other items could be things like, you know, if you're paying for a business mentor or any resources, white label templates, any accounting work, all of these things that aren't necessarily going to be, I absolutely need to spend this exact amount per client I have, but it is necessary for me to do what I need to do in my business.
Yeah. I think you've explained it so well. There's so much ambiguity in accounting. There's not really one answer. And I think I find with coaches, and you probably find this as well, because they are such a science background, they're like, I just want one answer. I was like, there's not one answer to all of this stuff. The way that my business runs is different to yours. But I think like as a really safe way to say it is direct cost, you just cannot run your business unless you pay these things. And indirect costs are your choice of investments, or hiring a podcast studio, or like doing a photo shoot with your client, like just like little bits and pieces that do run the business, but you would not require them to service.
Yes, exactly.
Yeah. So then you've paid your $500 of direct and indirect. That $1,500 left over, that's the 25% that you would put away. Is that correct?
So I would put away 25% of the income.
2,000.
Yes.
Yeah. Okay, cool.
So a quarter of that would be what I would put away, because after you've paid those expenses, you've then got $1,500 left. So if you've put a quarter of that $2,000 away, that's $500. When we look at the $1,500 at the end of the day, $500 is around that 30%. It's a third. So you've probably got the 30% that you would actually end up paying on your profit by putting away a quarter at the start.
And then you've got $1,000, which is yours.
Yes.
Yes. Unless we have more tax, which we'll get to.
Yes.
So just to keep it simple, what kind of taxes are there that coaches need to look out for? And I think the way that we'll structure this is maybe we do like sole trader tax and then we'll do company a little later. I know that there are some shared, but there's also some differences. Hey.
Yes.
Yeah. So let's just say a regular coach making $10,000 a month or less. What kind of taxes do they need to be aware of and be putting away for?
So the main two are going to be GST and the actual tax bill. And then as part of that actual tax bill, you're probably going to be paying PAYG installments every quarter.
Yeah. So when you say actual tax, what's that mean?
So that is the tax that you pay when you lodge your tax return at the end of everything. GST is not included in that. It's completely separate. So GST is going to be 10% of your income and 10% of eligible expenses. And those eligible expenses have to be domestic. So you have to source them from an Australian company.
Yeah, this gets everyone, hey?
Yes.
Yeah. So if we work off, I find that coaches work really well with examples. So if we're working off someone making $100,000 a year and they lodge their income as $100,000 to the tax department, is that how it works?
So that's going to be profit that you would lodge to the tax department.
Okay. So money left over at the end of all your expenses.
Yes.
So let's just say it cost them $60,000 to run their business that year and they've got 40 grand. That's what they lodged to the tax department.
Yes.
And then that is what your income tax is.
Yes. Yeah.
And then what's the tax rate for that $40,000?
For the $40,000, it's just 16% over 18.2K. Okay. So every dollar over that, 16%, basically 16 cents on the dollar.
Holy crap. And that goes up, doesn't it?
Yes.
Because is sole trader and employees taxed under the same brackets?
Yes.
Yeah.
Because they're all taxed under individual tax brackets. So as a sole trader, you are still just one person. So you're going to be taxed as that one person at single person tax rates.
Yeah. So for those who don't know who's listening to this, when you're an employee, the amount that you make is dependent on your tax. So isn't it like 0 to 18, you don't pay anything?
Yes.
And then 18 to
45.
45 is the 16. And then 45 to
135. It's a really big bracket.
Yeah.
So that one is 30 cents on the dollar, but it's only dollars over 45,000. And then you also have a base tax that you pay as well, which is why people probably say the Australian tax is so confusing.
Yeah.
Because you've got that one bit that you pay regardless, and then everything over the bottom of the bracket is what you pay 30% on.
Yeah.
So with that 30%, most people are going to be in this tax bracket. So what that really means is if you want extra tax deductions and you're looking at spending money to save on tax, this is where investing versus spending becomes a really big thing. Because if you're just giving away money on things that you don't need, you may be paying $100, but since it's 30 cents on the dollar that you're saving, you're only saving $30 in tax. So technically you've lost $70 on just random shit that you're buying. Whereas if you're investing that money, then you're actually getting stuff back from it. So that's when it becomes worthwhile.
Yeah. Let's break that down because even I'm like, okay, that's a lot. So you've got your tax brackets, which are all different. So that's one complication of tax. So then let's just say you've got your $40,000 profit, then you've got your tax on whatever that is. When you're talking about tax deductions, this is about spending money to benefit your business. Is that correct?
Yes.
Versus like buying a bag.
Yes. So if you're just buying, if you're just going to Kmart and buying a whole bunch of stationery that you don't need, or if you're, wanting to buy some white label templates or something like that, like white label templates that you don't need and you're only buying them for the purpose of getting the extra deduction, don't do it. Buy them because it's going to benefit you. Think about it before you buy it, basically.
So with your deductions, let's just say I spend $5,000 a year on stuff for my business and then I buy a $5,000 bag. From my understanding, and I might be wrong, right? So from my understanding, if I buy a $5,000 bag, they just say, well, that's a stupid decision. You're still going to pay tax on that bag. Like you're still going to pay that $5,000, whereas the investment would bring down the amount of tax that you pay.
Yes.
Is that correct?
Yes, because the bag has nothing to do with your work.
Yeah.
It's got nothing to do with your income. Even if you're posting it on social media, like they're not going to say that that's marketing.
Yeah, because that's something that I learned that my accountant was telling me. She was like, let's just say you have 100 and you spend 50 on something really stupid, you're going to get taxed for that 100 because they don't see a value in it. Yeah. Whereas if you have 100 and then you spend 50 on something with the business, they're like, cool, we're going to tax you on the 50%.
Yeah.
So that's how it works.
Exactly.
And that's where people can really make a big mistake with their tax bills and then they get hammered, hey?
Yes.
Yeah.
And a lot of people try to get around it by buying a car under their business and things like that. But if you're not actually using that car for work, and that does not include traveling from your house to the gym, because that's not work-related travel, you're going to do that anyways. The ATO is really strict on what they consider it. So if you're buying a vehicle under your ABN, it has to be for business use. And if it's not for business use, then you can't just use that as an excuse to not pay any tax, because it's not going to be part of your business, which means it's private. It's not going to count towards anything anyways.
I got smoked with that.
Oh, no.
Well, I do use my car for work. I got smoked with that and fringe benefit tax. I was like, what's this new tax? And then I got luxury tax as well because I got a BMW. And I was like, come on. But yeah, buying a car is not a smart financial decision, guys.
Yes.
Okay, so we've got that down pat. So regular tax is I make 100, I use 60 to run my business. I've got 40 grand left over. If I've got any stupid purchases, I'm going to get charged for them purchases. But if I make any smart investments, that's going to come off my bill and my bill is going to be a lot lower.
Yes.
And I feel like income tax, personally for me, income tax really isn't a big tax bill for like, as a personal experience, my income tax is pretty low. Like it might be, 40 grand or something like that, which I consider small because the GST is whopping huge. Yes. But it can be quite small, hey, like if you spend correctly.
Yes. And there are quite a few clients that I work with that, some of them work 2 jobs. So they might even get a refund on some things because their other jobs, business deductions and things like that, take off it, or because they're not earning that much from their business because they have that secondary form of income that's already paying tax throughout the year when they get paid. And that's the big difference between being an employee and running your own business when it comes to tax. And that's why people get stuck in, their first couple of years of business thinking that they're paying a huge tax bill that they're not used to, because they're used to paying very little or getting a refund back from when they were employees. And then the first couple of years of business, when they switch over, they're not getting it taken out of their weekly pay anymore. So it's all coming at the end of the year.
Yeah, they get hammered. Also, if you get money back at the end of tax year, that's not a good thing when you're an employee. It means you're being underpaid. That's what I learned. Like, okay. Last year, one of the girls didn't get a back pay. I was like, because I pay you, right? No, but one of the questions I do have is, say someone is an employee at the gym, right? They have an admin job. They're making $60,000 a year and then they start a business. Does the tax office, because you're an employee and you've worked for that and you've gotten that money, is that included in your tax threshold, or is it only money you've made on the side that's in your tax threshold?
So it's all included because it's all coming to you.
Yeah.
So when you lodge your tax return, you're lodging it based on your income overall. So both things will be included. The main difference is going to be that with your salaried job or your part-time role that you're doing at the gym is paying like taking tax out of your pay every single week.
Yeah.
So you won't have to pay as much at the end of the year. Whereas the part of your business, that's probably going to be where you're going to see most of your tax bill come from, especially because if you're earning 60,000 there and then you earn, say, another 10,000 from your business in profit, then that 10,000 is not going to be at the bottom of that threshold where you don't pay anything because it's bringing you up to 70,000.
Yeah.
So really, out of that 10,000, you're paying $3,000 in tax.
Yeah. It's so crazy. It's such a complex. This is why you need accounting help, guys. This would be like the ABCs to you, hey?
Yeah. A little bit.
Whereas me, I'm like, I have no idea what's happening right now. Okay, so then you mentioned something called PayYG.
Yes.
So is that my understanding? PayYG is payment installments to pay off your tax bill. Is that correct?
Yeah. The way that I like to explain it is it's basically prepaying your tax throughout the year.
Okay, so it's not back paying. Wait, that's right, because they make an assumption of what you're going to pay and then you pay that quarterly.
Yes.
Right.
So when you lodge a tax return that has business income in it, they look at that and they go, okay, so that they don't have to pay that extra $3,000 at the end of the year all in one next year, we're going to split that up. If we are expecting you to pay another $3,000 in your business, we're going to split that into 4, and then you're going to pay that every single quarter. And then at the end of the year, when you lodge your tax return, you've already paid that chunk. So that's going to be taken off your bill. The way that people get caught is that in those first few years of business, you tend to grow and grow and grow. So usually you're going to still be paying extra at the end of the year because the first year you may have only paid $3,000 in your business, but the second year you could have doubled that.
Yeah.
And so you've still got a $3,000 bill at the end of the year, but then your PAYG installments go up.
That's why they say tax is really heavy at the start of your business. Okay, so with the PAYG, you pay, it's basically like a funny acronym for a payment plan.
Pretty much, yeah.
So then you got your PAYG, and I'm pissed about this actually. So I heard that the HEX index that they took off has now gone to small businesses for their PAYG installments. Is that correct?
I wouldn't say that. No. You're still going to be, I mean, at the end of the day, it's not going to make a difference to you. Like whether you're paying more in the quarter or less in the quarter.
Yeah.
It's going to offset at the end of the year anyways. So you're still going to end up paying the same tax.
But didn't they like, my accountant said this to me. She's like, with your payment plans now, there's interest on them.
Not on all of them.
Not on all of them?
Not on all of them. Sometimes they do put interest on them, but I mean, typically that's only going to be for pretty big bills. So if you're just putting your like 4K BAS onto a payment plan, they're probably not going to charge you interest on that for the 12 weeks it's going to take you to pay it off. But if you've got like a $80,000 tax bill and you're paying it over the course of like 2-3 years, then that's probably going to be a point where they're going to be like, okay, we're going to charge some interest on that because they want to make sure that you're actually going to pay it.
That's why I get into it. Okay, so we've got a better understanding of income tax now. So income tax is your money left over after you've run your business, and then your PAYG is just paying that off, and then your accountant forecasts that.
Yes,
for next year.
And before we move on from that, that's not optional.
Not optional?
It's not optional.
That's actually pretty good that it's not optional.
Yes.
Yeah.
I have a lot of people ask me if they can get out of that system, and if the ATO puts you in it, no, you can't. You can't elect to leave it.
I had no idea.
If you stop your business, then there's things that your accountant can do to reduce it or get it down to nothing. Or if you're earning way less than you were, we can change it. But probably not in that first half of the year, to be honest with you, because like I never like to change any of mine until March, purely because there's still too much ambiguity between now and then. Like in the next 9 months, we don't know what's going to happen. Yeah. And if we turn to the ATO and we're like, nah, we don't need to pay any more for the rest of the year. And then you end up with like a 10K tax bill at the end of the year, you're going to be mad at me, first of all.
Yeah.
And then the ATO is going to be mad at both of us. And they're probably going to look into you a little bit more because they think that you're lying to them. So yes, if the ATO puts you into the PAYG installment system, you can't leave it. You kind of just have to suck it up. But at the end of the year, it is going to make it easier on you. Like, I would rather pay 4 lots of $2,000 than one big lot of $8,000.
I just see it as like a tax subscription.
Yeah.
It's like a tax membership. But like, it makes sense because ATO is a business and they need stable income. Like, I would prefer to pay it that way anyway, because there is literally nothing worse than getting the biggest bill and you're like, what am I going to do with this bill? Like, that's all the cash in my bank account.
Exactly.
Which is crazy.
You've worked all year to bring up these savings and it's all gone.
Yeah. And the bigger you get, the bigger the tax bills get.
Yes.
So let's jump into the tax that everyone hates. GST.
Yes.
I feel like people get really confused between the acronyms of GST and BAS and all of that kind of stuff. So simply, like, what is GST and when does it come into effect?
GST is a small service tax that you pay based on your income as an Australian.
Yeah. Goods and services tax.
Yes.
Yeah.
Yeah. So essentially what it is it's 10% of your income if you're registered minus 10% of Australian expenses. So Trainerize does not count for this because it's Canadian, I believe. It's US.
Yeah.
Somewhere in the realm of that. Same with Everfit, anything from the UK. Like, none of those things are going to count. If you're paying Canva's Australian. That's going to take 10% off.
Forward moves.
That's going to take 10% off. Exactly. So when it comes into effect is when you're earning 75 grand. And that's income. That's not profit. So if you've earned that over the past 12 months, you have to register legally. If you haven't earned that over the past 12 months, you can voluntarily register, but I don't advise anybody in the fitness industry to do that because you're probably going to pay more than what you get back, unless you're someone who's like opening a gym, because those investments are going to give you something back first. And you're probably going to earn that in the first year anyways.
Yeah, it's honestly making $75,000 is like, what, $1,800 a week? Not even. Something really, really small.
Yeah.
So working off the 100,000 we've got, so I make $100,000. Theoretically, we'll get into this, but 10% of that goes to tax. So then I take home $90,000 and then it's $60,000 to run my business, which brings my profitable tax down to $30,000, depending on expenses.
Yes.
Cool. So with GST, everyone freaks the hell out when this happens. And I feel like me and you have had a lot of conversations around this. And it is a scary thing because like when it happens, you want to charge that 10%. So like, you know, you do get that little bit more money back. But I feel like a lot of people don't understand how the tax actually works itself. I'm going to take a crack and you can tell me if I'm right or wrong.
Go for it.
Because my bookkeeper explained it to me. I was like, this makes so much sense to me now. She was like, GST is kind of like its own little economy, right? So you get taxed 10% of your income, which is $10,000. But out of that $10,000, if you spend $5,000 on Australian owned things to put back into the economy in Australia, your GST then comes down to $5,000. Is that how it works?
Yes. And it's dollar for dollar. So it's not like tax where you're paying 30 cents on the dollar or 16 cents on the dollar. It's one minus the other completely. So you're only paying the difference. The way that I like to explain it is that it's not your money, it's the ATO's money. So when you bring in your income, if you're looking at that, you know, $100,000, 10,000 of that isn't yours, like it's the ATO's. And then when you're looking at those $5,000 worth of expenses that are all Australian, then 50%, 10% of that is going to be offset because that's also the ATO's, but you've already paid it. So the ATO just essentially wants the difference.
Right. And so like with these expenses, say if someone's booking in this studio, would that be classed under GST because they're putting into an Australian business?
Yes.
And then, so it's not typically always going to be 10% you pay. It's probably going to be like a little bit less, but it's safe to put the 10% away anyways.
Yeah, I would usually say put 10% aside of your income. That way you're probably going to oversave a little bit, and then you just you have a bonus amount in your savings.
Yeah. Do you do that thing every month with your clients? My bookkeeper does it with me, and it's literally my lifesaver. She'll email me every month and go, you put this away for GST and PAYG. I'm like, okay.
Yes. So every month I give my clients a number for tax and BAS in full, because if you have PAYG and GST, they're both on your BAS. Now, because that's quarterly, I break BAS up into the full bill, 13 weeks. So 13 weeks in a quarter. So I just divide it by 13. Like, this is your total bill that you've been paying. To save that much, divide it by 13, put that aside every single week.
Yeah.
And for tax, I have a look at their profits. And as they change throughout the year, every single month, I'll give them a new figure. So, for example, I'll be like $202 a week is going towards tax, and another $303 a week is going towards your BAS, which is PAYG and GST.
What's BAS?
BAS is just the report.
Yeah.
So it's just the statement that tells the ATO, this is how much GST I brought in from my sales. This is how much GST I spent in my expenses. So there's the difference. So GST is the tax. BAS is the report. It's sort of like you pay tax, but you lodge a tax return.
Right.
Same thing.
So BAS is just tying everything into a little bow and saying this is what you owe every quarter.
Yeah, it's just the report that tells the ATO what number you're paying them, basically.
Yeah. And so we're already up to about 25% tax just from running a business with GST and income tax together. Hey.
Yeah.
Yeah. That makes so much more sense. I feel like everyone listening to this will be like, oh, it actually makes sense now. Like, I remember when I first started, I was like, what's a business activity statement? Yeah. I have no idea. So you, as long as you're paying like your BAS and you're working with an accountant who's all over your numbers, you're pretty safe.
Yes.
Generally.
Yeah. I think if you're like, your accountant does this for you, I do this for my clients, with that amount that you're receiving every single month, if you keep putting that away, then chances are you're either going to have everything saved completely so that whenever the bill is due, you can just pay it and then move on because it's already put aside for that.
Yeah.
Or it might be just the tiniest little bit. So instead of trying to find, $10,000 at the end of the year, you're only trying to find like $1,000 or something like that. It's going to make it a lot less stressful. Like if you're saving once a week towards these things, then you're not scrounging to find every little piece of savings that you have because it's already done. And every client that I have, and I'm sure you feel the same thing with your accountant, like every client that I have that puts away the amount that I tell them to has so much less anxiety around it.
I've never thought about tax once.
Amazing.
Besides the other day. The ATO is really mean, guys.
Yes.
They're really strict. Maybe I should tell this story so people know how strict they are.
Go for it.
But basically, I had a tax bill from my income tax last year. It was like a regular bill and we set up a payment plan for it, like the PAYG plan. And something had happened in my bank account where I set up the payments, but my bank had held the payments from the ATO. And me setting up in the background, I was like, oh, everything's all fine and dandy, like no stress. And then I get this email from the ATO and it's like, you have to pay a lot of money tomorrow. And I'm like, what is happening right now? And they were like, so like intense. And they were like, you have to pay it. Like you have absolutely no choice, or like, we're going to start adding interest to it. And I was like, but I've been paying it off. But because it defaulted, the ATO had an absolute meltdown and was like, no, you owe us our money. And then we obviously had to like pay a bit off and like restructure the loan and things like that. But the ATO is very, very strict. And I find that a lot of people are like, accountants are so strict. It's like accountants are strict because they know how psychotic the ATO is. Like.
Yeah. And people, like, just to be clear, I don't like tax either. I don't think anybody does.
Yeah.
I don't want you to have to pay tax, but unfortunately you do for us to have the systems that we have in Australia.
Yeah.
Like, it's just how it is.
Yeah.
So my job is to make sure that the ATO stays happy enough with you that they're not as likely to audit you, because if they audit you, they're going through everything with a fine tooth comb. And that is probably the most irritating process I've ever been through in my life. It sucks.
That petrifies me. And you literally cannot hide shit from the ATO. Like,
no, they'll ask you about everything, which is why doing your accounting and your bookkeeping is so important, especially as a business owner, because they want to know every single thing that's happening, and they're going to be more likely to audit a business owner than they are to audit an employee, because an employee has less that they can hide.
Yeah, and the ATO has access to your Stripe, guys. Yeah, so we should probably get into this. I don't know how long this episode's going to be. We might have to snip it into 2 episodes or something like that. But you literally cannot hide anything. And like running from the ATO is not going to help you. Like they will find you.
It just compounds. I had like a little bit of a rant on Instagram about this the other day, actually. I just started on a tangent. But I mean, sticking your head in the sand and ignoring it is not going to help. It's going to compound the issue. Like you said, like the ATO was saying, like, we're going to start charging you interest. Well, guess what? Now what was, you know, potentially a $5,000 bill that you were struggling with and wanted to ignore is now going to be like $6,000-7,000. You paid an extra $2,000 for no reason, just because you were unorganized, basically.
Yeah.
If you just get onto it, you can probably get into a payment plan, or you can figure something out with them to make it work.
Yeah.
But if you just ignore it, they're not going to want to do it for you, because you're not showing them any reason to believe that you'll pay them if you haven't launched a return for the past 3 years.
Yeah. I mean, we have to pay tax for the country we live in at the end of the day, even though it sucks.
Yes.
So then the next question we always get is, I'm a sole trader. When do I become a company? There's lots of talks around tax benefits because the tax rate drops, quote unquote, when you become a company kind of thing. But then there's additional taxes that people don't know about. So I know you can't do rule of thumb, but like generally, when would you start that discussion of saying from sole trader, we need to start looking at a company structure?
So in terms of profit from just solely a tax perspective, I'd say if you're not earning over $100,000 after all of your expenses, so your profit, not your income, in a year, it's not worth even talking about.
Yeah.
Because even though you do pay only 25%, when you look at all of the income, because there's not that little 18K that you're not paying anything on, which happens as an individual, you end up paying more overall, even though technically, quote unquote, 30% is what you're paying. So when we actually have a look at it, we want to be earning over 100K for that. And then the other main thing I look at is if you're going to be hiring an employee, which is different from just having a coach that you contract hours from, or just a VA that you contract hours from. The employee is essentially owned by you. And the only reason that I put that little disclaimer in there is because being a company is going to make it different from you. So it's going to give you that extra like banner of protection, so that if something goes wrong in the company, it's not going to take your home, your car, everything that you own to pay back what that issue is.
I feel like with this as well, though, people don't understand that as a sole trader, you and the business are one entity, but when you and you can take money out of that business, right? And there's no implications on that. Well, there is with your tax, but, you know, we'll get into that in a second, because I always talk about this to my clients. It's like, you should be paying yourself a frequent wage so you have some kind of understanding of what your net profit is before you take money out of the account. Just like, so you don't take it all out and then you're like, holy shit. But when you become a company, and this is something that my accountant sat me down and she was like, now that you're a company, she's like, you cannot take money out of this company free willy-nilly. She was like, you are an employee of this company. She's like, yes, you're the director, but you are an employee and it doesn't necessarily belong to me anymore. Like, yes, it's mine. And when you take money out of the company, there's slaps on the wrist and there's like taxes. Because, for example, if I take money out, then do I pay tax on that money as an individual as well?
Yes.
Yeah.
Yes. So there's a couple of ways that you can structure it. The main three is going to be you become an employee of your own company, pay yourself a wage. The second one is going to be you pay yourself a director fee, which is where you take the money out. You aren't you aren't an employee, but you're still paying that fee. It's deductible in the company as an expense, but you pay tax on it at the end of the year in your individual return. The other one is going to be through a loan. Now, that loan has its own implications. So I find that it's a can of worms best not touched, to be honest. But if you're paying yourself a wage, then that does mean paying yourself super and paying PAYG withholding, which is a completely different one as well. I know it sounds similar.
It's employee tax, isn't it?
But it's employee tax. Yeah. So if you've ever had like a part-time job, that little tax that they take out, that's because the company is paying that tax as part of their BAS.
I pay that tax.
Yes.
I get so mad about it.
So typically if I have a client who's in a company and they're an employee of their own company, they're paying themselves super from the company accounts. They're paying essentially most of their individual tax from their company accounts as well. So that in their individual tax accounts, they don't have that much of a bill to pay. The reason for that is because all of your cash and all of your income is coming in through the company. So if you're paying your tax through that, you're going to have more cash available there than you will personally. So it's going to be a lot less stressful than trying to find the tax to pay at the end of the year for your director fee, because that doesn't have the tax taken out of it. And you also get the added bonus of getting that super a little bit further up there as well.
Because as an employee in Australia, you have to pay super. There's no way around it. That's the law. That's the structure I use. So I made the company, I became an employee, then everything was taken care of, which actually is something that I personally really recommend to business owners, because I'm like, you pay yourself the 60 grand a year, your super's taken care of, your tax is taken care of, and then if you want to take a little bit out, you can put taxes kind of thing. Like that really helped me overcome how the whole tax system works, because I understood it as an employee.
Yes, I think it makes it a lot simpler and it has a lot more benefits to you as a person, because chances are if all of your income's going into the company and you're taking that director fee out and then having to pay tax at the end of the year, where is that money coming from? It's probably going to have to come from the company too, right? Which is just going to increase everything. And it's going to get to a point where transitioning to the company for that 25% tax rate, you're still paying more between the two. Anyways.
So when a sole trader becomes a company, they have to set up completely new systems, don't they? So new bank account, new Stripe account, new everything.
Yes.
Because it's a brand new business number. And basically, say if they had $20,000 sitting in their sole trader account and then they transitioned into a company and that money just went into that, is that considered a loan from you to the business to start up, or like starting money, or like what happens to that money? Who does it belong to?
So that money, if you put it into the company, you can kind of argue it either way, to be honest. A lot of times you can say, you know, that's just what it costs to start up the company. I'm not expecting to get that back at any point, so let's just leave it in there. It belongs to the company. It's just what I gave it. And then the company owns it. But then when you shut down the company, it comes back to you anyway because you own it. So
mine won't, because mine came out with drawings. It's so annoying.
But you can do it as a loan. So if you do it that way, then it's basically you saying, I do expect to get this money back at some point. So you can, when you start earning enough income through the company and have enough cash, you can take money out of the company to draw down that loan to nothing. But if you take more than what the loan was, then you're in trouble.
I was actually watching an interview with Adam Sullivan the other day, and he was talking about how he owes his company $4 million. And there was like a lot of talks like, how the hell does he owe his company $4 million? It's like, because when an owner takes money out of their company, they owe like, I said that to the girls. I was like, oh, I'm in debt to Forward Moves. They're like, what do you mean? And I was like, because I took money out for Caliator razor. And I had to pay like 10 grand. And like, I just didn't have that sitting around. We were like too early on in business. And I had to take 10 grand out. I was like, oh, I'm in debt to the business 10 grand. They're like, what do you mean? And I was like, oh, I took $10,000 out of the business. They're like, isn't that your money? I'm like, no, I owe the business now.
Yeah.
And they were like, how are you going to pay that off? I was like, I don't know. The accountant has to set up a payment plan or something. And it actually gets docked out of my pay.
Yeah.
Yeah. So
Which is
we're
a
paying it
great way
back
to
that
do
way.
it.
Yeah.
Because if you don't pay it back in full within a certain amount of time, then it creates a director loan because the ATO doesn't want you to try and take tax-free money out of the company.
Yeah.
And that's what it's trying to avoid.
Yeah.
So with that director loan, you then pay interest on that. So if you take 10 grand out of the company, the interest is around 8.5%.
Yeah.
It's pretty high.
cooked.
It's pretty high. And that gets added on as like income as well, interest income to the company. And it is an expense in your own personal name as well. But it creates a whole can of worms, which is why I say it's just best to not.
Yeah. This is why I'm such a huge advocate because I play with bigger money now. Like I'm playing with, 7 figures of income kind of money.
Woo.
And like when it comes to, I have never, even like when we were making like barely $400,000, $500,000 a year, I would always email my accountant and be like, can I take this out of the business or can I do this or can I do that? And then she would send me this essay of like, if you do it, I'm not saying you can't, but if you do it, these are the implications.
Yeah.
And so like that taught me a lot. And like now like I'm so grateful I had them lessons when I was younger, but more in the newer stages of business because now like, God, with like the money that comes into the business, and I'm not going to sit here and say like it's amazing. Business is business, right? A lot of money comes in. I don't look at that money and go, I'm going to buy 50 designer things this month with that money. I look at that and I go, oh, that's not my money anymore. Like you learn this whole new like discipline around money and you understand. And this is like, you probably feel this as well, but when you see people like flaunting their shit online, I'm like, surely you can't afford that. I know how much money I make and that's a considerable amount of money with a considerable amount of profit. I'm like, I can't do that.
Yeah.
I'm just surviving out here. Like
exactly.
Yeah.
Like, I don't know. I think a lot of it's going to be about priorities and stuff, like what you're going to prioritize buying.
Yeah.
Like, I mean, for you and me, like we're wedding planning.
Yeah.
We're not out here buying all of this random stuff because we've got bigger things cooking.
Yeah. And like big investments. And sometimes I had a moment the other day, I was like, that's not going to work. Like tax is it's like, where's my money?
Yes. And it can get pretty defeating because like, I mean, you could technically be getting paid like $3,000, but when you take into account everything that you're buying with it, all of your tax savings, GST and all of that, like you could be left with less than half.
Yeah.
And that's a really hard pill for a lot of people to swallow. But that's where it becomes really important to have somebody on your side looking into these things for you, like an accountant, like a business mentor or an advisor in some capacity, because then you can actually see this is how much money is coming in. This is how much money is coming out. This is what I need to put aside for tax, so I'm not even touching that. And then this is what's left after all of that, which is money that I can actually use for myself.
I would even give a caveat to that and say, don't ask your business mentor about finances.
Yeah.
Like everyone would know, like I have an advisor, I speak very highly of her and we will talk about income. I never take full income advice from my advisor. And it's not because I don't trust her. Absolutely, I do. I know that needs to come from my accountant because that's my team. And like, yes, we might have different experiences and we might be able to tell you that like, don't worry about this, or like a great example is like, you can't get away from NUI fees. You're paying for a luxury, right? Like that's what you need to pay. And that's one thing that I say to people. It's like, you cannot get away from that. Like you can't do bank transfers, but we'll get to this in a second. But when it comes to financial advice, I'm like, don't ask me. Go and ask your accountant and then bring it back. And then we can actually do something like that. And we share a lot of clients where I'm like, go ask Jordan.
Yeah. And I will go, this is something like people will ask me about like marketing and stuff. And I'm like, this is what cash is available. Tell Ash that number. She'll tell you what to do because that's not my area of expertise. Like, I mean, could I say how much you can spend on ads? I mean, yeah, but I'm not educated enough in that topic to be able to confidently be like, you should spend this much in tax. And that is where I think the big difference is between like what we do. Like, I can say you have this much available. You're going to be the one that says, for our strategy to work, let's try and spend this.
Yeah, this is where we disperse it. This is what we're doing with it. And
you'll be the opposite sort of end.
And honestly, like if your business mentor is giving you financial advice, that's a red flag. Like it really needs to be collaboration of the both for it to work properly. Because I'm not going to sit here and say I understand. I don't understand it.
Yeah.
Like I know that you're making money. Cool. Yay. But the logistics of that money, God, that's a whole different ballpark.
Yes. And I think as well, this is where it could be a really good thing to have them work together as a team, because like you could say, for my strategy to work, I'd really like you to be spending $200 a week for advertising. And then you can send that number to me and I'll be like, well, they're not at that stage yet where they have that available. They would need to save this much extra money in other expenses to make that work. And then that's where I can say, you know, going forwards, maybe let's try and cut out some of those unnecessary spends so that you can make that work. But this is what's available at the moment. So if you can make your strategy work with that, go for it. If not, we've got some work to do.
Yeah. It's so important to have a team like that. Hey.
Yeah.
And even a lot of things, for example, I'll say to my guys, we want KPIs of making this much money. And they're like, oh, but how do I do it? I'm like, go ask your accountant and be like, if I want to get to $200,000 a year, how many clients do I need to sign every single month? And then the accountant will give you a plan and then we can strategize that plan. Like it's not one service or the other. And I find that that's a very big thing in coaching. It's like, I can only have Jordan or I can only have Ash or I can only have this person.
Yes.
It's like, you kind of need everyone.
Yeah, getting everyone is like going to be the gold standard.
Yeah.
And that's going to give you the best results overall. Like, I mean, I tell you what you're earning, what you're spending, how to get to where you need to be in terms of like the specifics of what you need. But I'm not a person that's going to, like, I'm not an expert enough on the topic to tell you this is exactly how you can get there. And I think that a lot of times people blur that line because they know the principles of how to get there. And like, I mean, sure, I know the principles as well. But am I going to be someone where I can come from a place of genuine authority and advice on this? I don't consider myself that. You are that.
Sometimes. Sometimes. It's a funny thing. I do mention this a lot. I think in a couple podcasts I've said it. I was listening to an interview with Toby Pierce once and he was talking about listening to your accountant for financial advice. And he was like, well, I don't take business advice from them because their goal is to protect the money. And it's kind of like that whole debacle of like protecting money, spending money, protecting money, spending money. And it's like, that's where it's good that your business has come into it because you understand both elements of it. Yes. Whereas like my accountant's like, we are not spending any money. I'm like, I have to build the studio kind of thing. Yeah. And she was like, no, we're not doing it. And it's because it's such a misunderstanding of what the industry is. It's super important to have both. Yeah.
And I think that's why I sort of went into the realm of I'm not going to take on anyone that's not strictly in the fitness industry for my monthly like bookkeeping and advisory services. Like I do have a business degree. So I am like, I do have an understanding, like that basic understanding of how that's going to work. But, you know, like I find a lot of people, if they're not in the industry, they just don't have that extra bit of understanding of how it works and how it's all going to work together in the future. And I think investing into your business is going to be something that pays off. And if you are going to spend the money, then I want you to spend it on something that's going to benefit you in the long run. Yeah. So like this studio, this is a great opportunity for you guys because first of all, you do the podcast. So you need a space where it's going to work for you. Then you can also hire it out. Other people can use it. Other people can come in, use all of this equipment and everything like that. And then over a period of time, it's going to get to the point where you've earned more than you spent on it.
Yeah. Oh, I wish that time would come soon. Don't we all? We like budgeted 20,000, and the other day I had to do my insurance report, and my insurer sent me like my contents. It's like to Ray, it was so funny. It was like $20,000 for all the contents. I was like to Ray, I was like, how much money have we spent on the studio? She's like, oh, 40 grand. I was like, I had to like update the report, and I was like, oh, I'm so sad.
And see, like, even as an accountant, my first reaction to that was like, oh, 40
It was
grand.
just these things. It was like, cool, we'll buy the furniture, and then the computer broke, and then we had to buy a new computer, and oh my God,
happens.
so bad. But it's all investments.
Yeah, exactly.
So I don't know, do we end this episode and start a new one when it comes, or do we have like a really long episode?
I'm fine with either.
We can cut it into
your
two.
podcast, girl.
Cut it into two. There's a couple of things I want to talk about, like frequent discussions I have with people. Number one, bank transferring to avoid fees.
I don't think it's worth it.
Yeah. People get really upset about the fees, and I get it. I get it. But I always in the mindset of the fee is a luxury for the service because it's an automated service. But what's your thoughts around like some of the NUI fees can be pretty extensive?
They can be, but I mean, personally, I pass them on to my clients.
Yeah.
The reason for that is because like this is something that I think a lot of people do. And the reason for it is because an extra $3 a month from your clients is not going to hurt them as much as $3 times the 50 to 70 clients that you've got all coming out of your own account. That brings down your income quite a lot. And I don't think that many people are going to complain about a transaction fee because you're paying it on most things anyways.
Yeah, we all know it.
Yes.
And then the next thing is the rule around GST. I feel like a lot of people don't know that rule.
Yeah. So GST does not apply on bank fees because it's like a government thing. So this is where it can get a little bit trickier because your transaction fees that you're footing, you're not going to get the GST kickback on that. But when it comes to like your income, if you're passing that fee on to your client, like, I mean, you're still going to be like, they're going to be paying the fee. So you're not getting that reduced income from it. And so even though you're not getting the GST kickback, you weren't anyway. So you're saving the money overall. And like, I mean, for a service like NUI where you can see who's overdue, you can stay on top of payments, you can auto retry it. They now have the AI agent, which is fantastic. Like they do the emails for you to tell people that they're overdue.
Yeah.
That,
what's your thoughts on NUI as like as a girl in finances? Have you changed your opinion on that app? Because I know that at the very beginning, people were like, oh, it's on the phone. Like you can't manage finances on the phone. But knowing what you know now, like, do you really, really love that app to manage finances?
I do. It's not the be all and end all though.
Yeah.
Like I have Xero and you have Xero too.
Xero is literally my life.
Yes. And so Xero is where I manage my finances.
Yeah.
NUI is where I manage my customers.
Yeah.
I wouldn't suggest anyone manages their finances purely on NUI because that's not what they're for.
Yeah.
And they're an amazing app. They do all of the things. And I'm pretty sure they're coming out with a desktop version soon.
They've got it already on Mac. Oh, have to have a Mac,
that's
guys.
right. Yeah, it's on a Mac.
Have you got an Android?
I don't have an Android, but like my computer is Microsoft, like Windows based.
This is so funny. I had a client and I'm working with him and his girlfriend and she has an iPhone and he has an Android and she got on NUI and he bought an iPhone. Because he was like, I'm so over using Stripe.
Yes.
But yeah, I feel that, but also having to classify the GSTs in your price is a law in Australia. So it either needs to be including or excluding GST. And I always say have it as including because there's nothing worse than getting 10% put on at the end of the purchase.
Yeah. And that's how it works for the most part in Australia as well. Like I'm sure anyone who's traveled across to America would probably know this. I mean, I haven't personally, but I've heard it from a lot of people where they're like, you know, you just don't know what you're paying until you get to the register because they don't include taxes in their prices there.
That's what the taxes are.
Yes.
Every time I buy an American website, I'm like, this is a fucking joke. I was like, I get so mad about it. Yeah. Okay.
Whereas here, for pretty much everything that you buy, the price that you see on the shelf, the price that you see on the site is what you're paying. So I would recommend doing that as well, especially from a customer's point of view, because if I'm going to buy something and I'm going to invest in something and I look at it and it's like, this is $90. I'm like, okay, I can spend $90. That's fine. If I get to the end and it's like $99 plus a transaction fee, then it's over $100. And I'm like, that's different to 90. It feels different, even though it's not technically that much.
Yeah.
Whereas if you're just going to say 99 from the start, I'm already preparing to pay $100. So when it's there and it's paying $100, I'm like, yeah, okay, that's like, I knew it. I'm not surprised to see the number at the end and then getting to the end and being like, no, I'm not actually going to buy this.
Yeah. Do you have a calculator? I have a client in general. They're like, I want to take home this amount per week. And it's like, okay, we have to backtrack the GST, the fees. Do you have a calculator that does that? Like a spreadsheet?
I use Excel and do it manually.
Yeah.
Just because, like, I know how it works.
Yeah.
And so I can backtrack that pretty easily by myself. But, I mean, if you're looking at doing that and you're wanting to know how much it is, then genuinely, like, all I would say to do is look at, you know, what your expenses are. That's going to be the main thing that you need to cover all of your expenses. Add what you want to take home after that. So if your expenses are $500 and you want to take home $1,000, you need to make $1,500 minimum just to cover all of that stuff. If you're registered for GST, add 10% on that. And then, of course, for tax, just add the extra 25. So then just work backwards and just go what you want, expenses, tax and GST. And then that's going to give you a baseline number of where things are. And then with that, you've got your income, divide it by your price. That's how many clients you need.
See, your brain does that. And I'm like, yep.
You're just like glazed over, like, totally, for sure.
It's funny because the Nui boys made me a spreadsheet. And it was like this spreadsheet of
so
like,
great.
if I charge $50 a week, I want to get that $50 into my pocket. So what do I have to charge with the fee and the GST? That saved my life. It was the best thing ever. Yeah. You should definitely make one.
Yeah, maybe I will.
Yeah, it'd be so good. People would love it.
Yes, I have like a little budgeting spreadsheet which goes through everything and then talks about your savings and stuff. But I should definitely make one that works backwards.
And then when it comes to attacking on GST, and then say you have 10, 20 clients and then you register for GST, what would the next steps be for you when it comes to charging GST, doing the price increase and the communication, because you need to make it clear that you collect GST. So what kind of advice do you give your clients?
So if they're just registering for GST and they haven't updated their pricing in a while, then I would say just add 10%. And then I would also say at this time, have a look at where you're at compared to where you were when you set these prices. If you set those prices 2 years ago, you're probably going to need to up them anyways. So in that case, I would probably up existing clients 10% so that I'm still getting the same from them. And then, like, this is just me personally, because it's going to be about what you're comfortable with and what you have the confidence to sell. I would up existing clients 10% and then increase my new prices to 10% and then a little bit extra based on what I think my services are now worth. So if you think that your services and what you do is worth $80 a week, then add the extra 10% on that, charge $88 a week for all new clients. If you're only charging $70, just add $7 onto it. Then you're still going to be taking home the same from them. If you're comfortable charging more, do it. If you're worried about losing clients, then those clients, if they're going to leave you over $10, they weren't going to stay long term anyways, and they're not going to help you grow your business anyways. So if they're not going to value you enough after working with you, then okay, that's great. It was wonderful working with you. Sorry to let you go.
Yeah.
It's not the end of the world to lose a client.
When we got GST, we just upped our prices by 10%. Everyone was chill with it.
It's the easiest thing. And I think that a lot of people get concerned about how their clients are going to react. And to that, like, they feel like they have the need to over-explain things. Like, I'm increasing my prices because of increasing costs and because I've done this course and this course and that course and I'm now offering this and that. But I feel like if you do that, people are going to naturally just be like, okay, well, I don't really need this little extra thing. Do you have a discount for people who aren't wanting that extra thing? So I would honestly just send out a bulk email to everyone being like, hi, I really want to thank you all for being fabulous clients. You know, you're awesome. We are increasing our prices to this amount.
Mm-hmm.
This increase will take place on this date going forwards.
Oh,
any questions, let me know.
That is music to my ears. Because I find that when I do price increases, they're like, okay, so I say I'm going to add all this. I'm like, no. Because every time you do a price increase, they're going to be like, why?
Yeah.
Why? What have you added on?
What extra are we getting?
Yeah.
What extra you're getting is like, you've got an extra 6 months worth of expertise and knowledge.
And on top of that as well, do not let the client run your business.
No.
You have, and like this has happened to me so many times where like we put the price up in one of our programs by $1,500 and someone was like, the last time I inquired it was 6 and I was like, cool, it's 7.5 now. Yeah. And they're like, why? And I was like, because I'm not giving you a reason as to why. I'm saying this is what it's worth.
Yeah.
And I think when you tiptoe, when you over explain yourself, 1, you're discrediting your authority, but 2, it's kind of unprofessional in a sense when you over explain everything. It's like, as a business owner, this is it.
Yeah. I think that it creates the ability for that potential client to disrespect you. Whether they're doing it intentionally or not, that's basically what they're saying by saying, I don't think you're worth this much. If you don't think I'm worth that much, that's totally okay. You're more than welcome to have that opinion, but we're not a good fit to work together.
Yeah.
So...
And never, guys, never. If someone tries to bargain you for your services, never say yes because you always go, why the hell did I do that?
And then it opens the door for you to do it to somebody else. And I think it almost builds resentment against that person for something that's realistically not their fault. Like, I mean, when you think about it, like we all kind of want to haggle to get something cheaper, right? Like everybody loves a sale. But if you let somebody diminish your price like that, then it's just not going to work for you long term. It's going to make you feel guilty for charging your initial price, and it's going to make you feel like you're not worth that price that you set.
And you're going to resent your customer for it.
Yeah.
But it's because you allowed them to do that.
And then if you build up resentment, you're probably not going to give them the service that you ordinarily would anyways. It's not going to be the same quality.
They're just not your client anymore.
Yeah.
And that's okay.
It's fine.
That wraps up part 1 of our conversation with Jordan Birch, accountant for online coaches and PTs from FitBooks. Part 2 will be released this Friday. Make sure you tune in.